Welcome to the debate. In 2014, there was this rural janitor, right, hitchhiked to work, lived incredibly simply, and he died with an $8 million fortune.
Wow, 8 million.
Yeah, and that very same year, a Harvard-educated Merrill Lynch executive filed for bankruptcy. I mean, it really begs the question, in what other field on earth can a total novice routinely outperform a world-class expert?
I mean, honestly, it really doesn't happen anywhere else. You don't see an amateur stepping into an operating room and outperforming a trained heart surgeon or, a novice building a better reactor than a nuclear engineer.
Right, exactly, which frames the core controversy we are exploring today from our source material on the psychology of money. In the pursuit of long-term wealth, is financial success a product of formal intelligence and technical expertise, or does it purely depend on personal behavior and emotional control?
It's a fascinating divide.
It really is, and I'll state my position clearly. I am firmly in the behavioral camp. I argue that wealth building is fundamentally a psychological phenomenon where emotional control and soft skills completely override academic brilliance.
Well, I come at it from a different way. While behavior absolutely matters, financial realities are ultimately dictated by complex, unyielding mathematical truths. I argue that without foundational intelligence regarding risk, mathematics, and market realities, behavioral discipline is, frankly, essentially powerless.
That's an interesting point, though. I would definitely frame it differently. To see why irrational behavior overrides academic brilliance, we just have to look at why that Harvard executive, Richard Fuscone, went bankrupt.
Right, the Merrill Lynch guy.
Yeah. I mean, it wasn't a math error, right? He understood finance better than almost anyone. He failed because of ego. He borrowed heavily to maintain an 18,000 square foot mansion.
Oh, wow.
Yeah, and when the 2008 crisis hit, the sheer greed of that leverage wiped him out entirely. Finance is taught as a hard science, with rigid formulas, but none of that matters if ego overrides your system. The highest dividend money pays is control over your time, and you get that through humility, not high-level calculus.
I look at Fuscone's failure through a mechanical lens, though, not just an emotional one. Yes, ego played a role, obviously, but the mechanical cause of his ruin was a catastrophic loss of structural leverage.
Because he borrowed too much?
Exactly. He completely violated the mathematical law of margin of safety. If you're arguing that Ronald Reed, the janitor, succeeded purely because he was humble and patient, you're completely ignoring the structural vehicle he used.
But his primary vehicle was patience.
It was patience applied to a mathematical mechanism. Think about it. If Ronald Reed had patiently and humbly stuffed his savings under a mattress for 50 years, would he be a multimillionaire philanthropist today?
Well, no, inflation would have steadily destroyed his purchasing power.
Right? Exactly. He relied on the structural intelligence of the equity markets. He consistently invested in blue-chip stocks. That is a mathematically sound strategy. Financial realities are dictated by complex truths, like exponential compounding.
Sure, but
Emotional control without an intelligent understanding of those realities is just blind optimism.
the math of compounding only works if the psychology of the investor actually allows it to.
You still have to grasp the math first. And human brains just aren't wired for it. We think linearly. Let's test this in real time, actually. If I ask you what 8 plus 8 plus 8 is,
24.
easy. But if I ask you what 8 times 8 times 8 is,
Oh, right, I'd need a second. It's 512.
see? You had to stop and compute it. Exponential compounding is incredibly counterintuitive. To succeed, you really must possess the intelligence to understand it. Look at Warren Buffett.
Right.
His secret isn't just behaving well. He utilizes massive technical expertise to generate 22% annual returns over 75 years. That requires profound formal intelligence.
I'm not totally convinced by that line of reasoning, because theoretical math is entirely useless if you lack the psychological trait of survival. Take Jesse Livermore.
The trader from the 20s, right?
Yeah. In the 1929 crash, his technical market acumen was so sharp he made the equivalent of $3 billion in a single day.
He read the market mechanics perfectly.
On paper, yes, but then he grew overconfident. He took on massive debt, couldn't handle the emotional swings, and lost everything. He actually later took his own life. You say math is the engine of wealth, but if you build a financial strategy purely on optimal math, it's like building a 100-story skyscraper without sway joints.
Interesting analogy.
Right? It looks incredibly tall and structurally perfect on a blueprint, but the first psychological earthquake, like a market panic, shatters it because it's just too rigid to bend. Getting wealthy requires intelligence, I'll grant you that, but staying wealthy requires fear and humility.
I hear you. I'm sorry, but I just don't buy that. Let me tell you why. Humility alone does not keep the building standing. Survival requires technical intelligence to build a mathematical margin of safety. You can't simply feel humble your way through a 30% market crash.
Well, how does math save you if you're actively panicking?
By structuring your assets to absorb the blow beforehand. Look at long-tail distributions in the stock market. If you take the Russell 3000 index, which measures the broad U.S. stock market, historically about 40% of those companies effectively fail and lose all value.
Which is a massive failure rate to stomach for anyone.
It really is. But roughly 7% of the companies account for almost all the massive market-driving returns. To survive these tail events, an investor has to use technical intelligence to structure a portfolio that can absorb the 40% failure rate while capturing the 7% winners. That isn't a psychological feeling. That is a rational mathematical allocation of capital.
I see why you think that, but let me give you a different perspective on being, coldly rational. Let's look at how theoretical intelligence actually fares when tested by real human emotions. Researchers at Yale published a study proving mathematically that young savers should use 2-to-1 margin debt.
Wait, meaning borrowing $2 for every $1 of their own money to invest?
Yes, exactly. To supercharge their retirement accounts when they have decades to recover. On a spreadsheet, leveraging early in life to maximize long-term exposure is mathematically optimal.
Right, because the expected return of the market outweighs the cost of borrowing over a 40-year horizon.
Exactly. But in the real world, it is a catastrophic strategy. Why? Because a 2-to-1 leverage ratio means if the market dips just 50%, your equity is wiped out completely. You hit zero.
Yeah, that's true.
No normal human can emotionally endure that kind of catastrophic drop without panicking and selling at the absolute bottom. Even Harry Markowitz, the man who literally won a Nobel Prize for exploring the mathematical trade-off between risk and return, ignored his own optimal research when investing his personal money.
Wait, really? What did he do?
He just split his money 50-50 between stocks and bonds to minimize his future regret. He aimed to be reasonable rather than rational. Psychological comfort must always override optimal mathematical intelligence, because if a strategy makes you quit, the math is totally worthless.
That's a compelling argument. But have you considered that Markowitz's 50-50 split is still a mathematically sound structure? It seems we are arriving at a fundamental difference in how we view the foundation of wealth. From your view, money acts as a magnifying glass for human behavior. Ego and the desire to impress others routinely destroy mathematical perfection.
Yes, the ability to control your ego is the true engine of wealth.
While my stance is that emotional control merely keeps you on the path, the mathematical intelligence understanding long-tail risks, exponential growth, and structural margin of safety is the actual path itself.
Yet I think we both find ourselves converging on one profound realization here. Financial success is deeply influenced by things outside of rigid formulas, like the end-of-history illusion.
All right, that psychological quirk where we recognize how much we've changed in the past, but drastically underestimate how much our goals and personalities will change in the future.
Precisely. You might build the perfect financial model for who you are today, but the person you'll be in 20 years might have entirely different desires.
Because of that, navigating wealth requires an immense amount of intellectual humility, regardless of whether you lean heavily on the math or on the psychology. We've really only scratched the surface of the source material. There are many more invisible layers to wealth, time, and human behavior to explore.
Definitely.
We leave it to the listener to decide for themselves. Do you need to sharpen your financial mathematics, or do you simply need to master your own ego?
So, the next time you look at a spreadsheet mapping out your financial future, remember that the numbers are only half the story. You can build a strategy that looks flawless on paper, but if you don't account for the human mind executing it, you're never getting off the ground.